Hey guys, welcome back to the channel. Today, we're diving into Microsoft's latest Q2 2025 earnings report, breaking down the numbers, their AI growth, and whether MSFT stock is still a strong buy in 2025. With the AI revolution in full swing and Microsoft's cloud business booming, is this tech giant set to dominate the future? Let's find out. Microsoft is more than just Windows and Office. Its business spans AI, cloud computing, gaming, and even cybersecurity. But with rising competition from Google, Amazon, and Nvidia, can Microsoft maintain its lead? Stay tuned as we break down their business model, key revenue segments, and what these earnings mean for the stock. Microsoft's business model is built on software, cloud computing, AI, and enterprise services, making it one of the most diversified tech companies in the world. Instead of relying on just one product, they generate revenue from multiple sources, with a strong focus on subscription-based services and cloud dominance. Microsoft has three main revenue segments that drive its business. First, productivity and business processes. This includes Microsoft Office, LinkedIn, and Dynamics. Most of this revenue comes from businesses and individuals subscribing to Office apps like Word, Excel, and Teams, as well as LinkedIn's premium services and job ads. Second, intelligent cloud. This is Microsoft's biggest growth driver, powered by Azure cloud computing, AI, and cybersecurity. Businesses worldwide use Azure to run their operations, and with the rise of AI, Microsoft is integrating AI-driven tools into its cloud services, making it a major competitor to AWS and Google Cloud. Third, more personal computing. This segment covers Windows OS, Xbox gaming, Surface devices, and advertising from Bing and LinkedIn. Windows licensing brings in steady revenue, but gaming is also a big part of Microsoft's business, especially with Xbox Game Pass subscriptions and the Activision Blizzard acquisition. Microsoft's strategy is clear. It's moving towards AI and cloud-first solutions, securing long-term recurring revenue while expanding in high-growth areas like enterprise software, cybersecurity, and gaming. Microsoft just reported its Q2 2025 earnings, showing strong growth across key segments. Revenue came in at $69.6 billion, up 12% year over year, with net income rising 10% to $24.1 billion. Earnings per share hit $3.23, slightly ahead of expectations. All right, now let's break down Microsoft's revenue and earnings by segment to see where the growth is coming from and which areas might be slowing down. Microsoft's Productivity and Business Processes segment reported $29.44 billion in revenue for Q2 FY25, up 14% year over year. Operating income came in at $16.89 billion, growing 16%, while operating expenses increased 6%, mainly due to AI and cloud investments. Microsoft 365 commercial cloud revenue grew 16%, while consumer cloud increased 8%, with total subscribers now at 86.3 million. LinkedIn revenue grew 9%, slightly slowing down, and Dynamics 365 revenue increased 19%, continuing strong enterprise adoption. Microsoft's Intelligent Cloud segment reported $25.54 billion in revenue for Q2 FY25, up 19% year over year, driven primarily by Azure's continued growth. Azure and other cloud services grew 31%, maintaining strong momentum but slightly slowing compared to previous quarters. Server products revenue declined 3%, while enterprise and partner services dropped 1%, showing some weakness in traditional infrastructure. Operating income came in at $10.85 billion, growing 14%, though operating expenses also increased 10% due to investments in cloud engineering and AI infrastructure. Gross margin dollars grew 12%, but overall margins slightly declined as Microsoft continues scaling its AI infrastructure. Cloud remains Microsoft's biggest growth driver. Microsoft's more personal computing segment saw revenue remain flat at $14.65 billion in Q2 FY25. Windows OEM and devices revenue grew 4%, while Xbox content and services barely grew at 2%, a significant slowdown compared to previous quarters. Search and news advertising revenue increased 21%, continuing strong momentum. Despite revenue staying flat, operating income surged 32% to $3.92 billion, driven by improved margins in gaming and advertising, along with a 1% decline in operating expenses. The gaming slowdown and weak PC demand remain concerns, but strong growth in advertising and cost controls helped improve profitability. Overall, the earnings call highlighted Microsoft's strong financial performance and strategic focus on AI and cloud computing. The company's diversified revenue streams and ongoing investments in emerging technologies position it well for future growth. So why did Microsoft stock drop after its latest earnings report, even though the numbers look strong? There are three key reasons investors reacted negatively. First, slower Azure growth. While Microsoft's Intelligent Cloud segment, which includes Azure, reported a 19% revenue increase to $25.54 billion, this actually fell short of analyst expectations. Investors were hoping for stronger cloud growth, and the slight deceleration in Azure's expansion raised concerns about whether Microsoft can keep up with competitors like AWS and Google Cloud. Second, concerns over AI investments. Microsoft's AI-related revenue hit a $13 billion annual run rate, up 175% year over year, which sounds great on paper. But here's the issue. AI infrastructure is expensive. Microsoft is pouring billions into AI, and investors are worried about the heavy capital expenditures required to maintain its edge, especially with new competition emerging from companies like DeepSeek and Google's Gemini. Third, cautious forward guidance. Microsoft's future outlook was more conservative than expected, particularly for its cloud business. This made investors question whether Microsoft's high growth rates can continue in the near term, adding further pressure to the stock. In short, despite Microsoft's strong earnings, investors saw enough red flags to take some profits off the table. Slower cloud growth, expensive AI expansion, and a cautious outlook all played a role in the stock's drop. Microsoft is an absolute powerhouse, no doubt about it. Their AI and cloud growth are strong, and they continue to dominate in multiple sectors. But at this point, a lot of that future growth is already priced into the stock. It's still a great company, but for investors looking for the highest potential returns, there might be better opportunities elsewhere. Personally, I'd be more interested in Microsoft if it dropped to the $300 to $350 range, where the valuation makes more sense. What do you think? Is MSFT still a buy at these levels, or are there better plays in the market? Let me know in the comments.